Hey, what's going on everyone? It's Griffin here, back with another video based on popular demand. Today we're going to be going over stock market investing basics part 2, which is a sequel to the stock market investing basics part 1 video that you can check out right here if you haven't already. And in this video, we're going to be going into more in-depth concepts to help you better understand and navigate stock market investing. The first video I made on this topic, called Basic Stock Market Terminology, covered concepts such as stocks, bonds, REITs, dividends, dividend yields, market cap, and a bunch of other topics. It got a really great response from the audience. So if you want a refresher on these topics, or if you're not even sure what all of these are, then make sure to check it out before watching today's video. I'm going to be leaving a link down in the description for easy access. Also, I had a lot of people ask me to convert these videos into written blog format for easy reading. So if you're interested in checking these out in written blog format, then head on over to my website, griffinmilks.com. There's a link down in the description once again, where you're going to be able to consume all the information that I cover in my videos in written blog format if that's what you prefer. All right, so today we have 7 awesome concepts we're going to be covering in the video and unpacking, and hopefully by the end of the video you're going to have a much better understanding of how each one of them works and how you can apply them to your stock market investing. So without further ado, let's jump right into the first concept in today's video, which is how you can go about understanding and reading a stock market quote. So if you've ever looked at stocks online, then by default, you've been exposed to a stock market quote in one way or another. At its most basic format, a stock quote is basically a snapshot of the current market value of that stock, as well as most likely some historical information about that stock's price and other technical indicators. So while a stock quote can provide a lot of different information to the reader, generally speaking, a bare bones stock quote is going to provide the reader with a current market value for that specific stock, as well as some other information such as a 52-week high and low price, bid price, and ask price at the current moment, as well as volume throughout the period of time selected. And then it's also going to most likely have some other indicators such as book to price ratio, EPS, and price to earnings ratio, which are 3 concepts we're going to be looking at later on in today's video. And it's important to note here that depending on where you're consuming the information related to the stock quote for a specific stock or ETF, let's say, different information sources are going to provide the reader with various different indicators or information regarding that stock. Generally speaking, when I want to do some research on a new stock or ETF I'm interested in, I start my preliminary research on TMX Money, which is the website for the Toronto Stock Exchange. I just find they have some pretty good information there. It goes relatively in depth, and you can have a really good snapshot of what's going on with a specific company, as well as they have some pretty good charting for free, and you can also look at dividend history and the financials of the company. So you know what, let's actually have a visual example of this. Let's hop on over to TMX Money, and quickly we're going to go over a stock quote so you have a better understanding of how it all works and what information you're specifically looking at when assessing a stock, ETF, or REIT, for example. All right, so this here is your basic stock quote on TMX Money. Right now we're looking at Allied Properties, which is a REIT that we've talked about in previous videos. As mentioned here, the first thing you're going to see is the ticker symbol, and followed by the market price of the actual asset we're looking at. And then right here, there is the percentage change in the actual day of trading. So right now is a Saturday, so this is actually yesterday on Friday when the markets were open. And then we have the volume of shares that were traded during that day. Following here, we have the day low, which was $54.22, and the day high, which was $54.66, meaning that the price right now sits somewhere in between the day low and day high. And then right to the right here, we have the 52-week low and the 52-week high. So as you can see, actually, the 52-week low here, AP.UN's gone up by roughly, what is that, about 20% in the last 52 weeks. So really awesome. And then moving down here, we have the chart. As I mentioned, you can filter it through different periods, let's say 5 years. You can see really nice steady growth here of AP.UN, which is a solid REIT that I would really recommend looking into. And then moving down, we have the detailed quote, which is where you get the most information. So for example, once again, open, high, previous close, and low. as well as the total shares of all classes that are out in the market. So right now there's 116 million shares out in the market with a market cap of $6.346 billion. So the market cap really is just the listed shares out multiplied by the current market value of the actual asset. We have the dividends here. So the dividends right now for AP.UN are 13.3 cents per share per year, and the dividend frequency is on a monthly basis. And then we have the indicators here. So price to earnings ratio, earnings per share, dividend yield, PB ratio, and these are actually all indicators we're gonna look at further in this video. Moving on now to the second concept in today's video. It's one I guarantee you've heard of before and is one of the main reasons why a lot of investors tout the importance of starting to invest as early as possible and investing as much as possible when you can. You might have guessed it, I'm speaking here about compound interest, which Albert Einstein himself even called the eighth wonder of the world if you understand fully how to utilize it to your advantage. Compound interest is actually a pretty simple concept to understand. However, if you're new to investing, it can take some explaining to really comprehend the positive long-term impact that compound interest can have on the growth of your portfolio. In a really simple explanation, it's basically interest that you're incurring on top of the combined previous interest incurred and principal capital, meaning you're gaining interest on top of interest, and over time as you stay invested and you're incurring interest on interest, this has an exponential growth pattern to it, meaning that your portfolio grows by larger chunks year after year. The easiest way to really understand this concept is, in my opinion, with a visual example. So let's say you started with $1,000 as your starting capital that you're gonna start investing with. And just to keep things really simple for the sake of understanding the concept we're looking at here, we're going to be looking at a 25-year investment horizon with a consistent 7% interest rate on our investments. Now, obviously in the real markets, having a 7% consistent growth rate year after year is not realistic or feasible, but once again, just for the sake of this example, this is going to paint you a really good picture of the concept and how it works. All right, so we're starting here with our initial capital of $1,000. So year one, we start with $1,000, and let's say we incurred a 7% interest rate on that $1,000 capital. Well, at the end of the year, this investment will have grown to $1,070. In year two here, we're going to be receiving that same 7% interest rate, but this time it's not on the $1,000, but rather on the $1,070. So this translates into gains of $75 in year two, bringing your total investment value to $1,145. So with this example here, year after year, you're incurring interest on the new balance of your account instead of only on the primary principal that you invested at the beginning. Now, I do realize that with this example, these are pretty small numbers, but nonetheless, even if you had your $1,000 invested over that 25-year period with a 7% compound interest rate, your investment will have grown at the end to roughly $5,700, which is awesome without even contributing more contributions on a monthly or yearly basis to that account. Moving on now to the third concept in today's video. It's one that builds off of the previous concept we just looked at, as well as dividends and dividend yields that we covered in the last video. As a dividend growth investor, the main reason why most people are attracted by dividend paying assets is because of that monthly or quarterly dividend payment that they're receiving from their investments. And hopefully, if you have a long time horizon ahead of you for your investment portfolio, these dividend payments are reinvested back into your portfolio, thus buying more assets and therefore having an exponential growth on the dividend payments received in your account, as well as the growth of the actual value of your portfolio. So with this said, this can basically come down to the same general concept as contributing on a recurring basis to your investment portfolio, thus allowing you to buy more assets, having more growth, more interest, and more dividend payments. Generally speaking though, what happens when you receive a dividend payment within your investment account, these companies are going to be paying out cash to your account, and therefore you're going to receive those payments as a cash payment, and it's just going to sit in your investment account without being reinvested into your account and having the positive effects that we just covered. However, what you can do in order to constantly reinvest those dividend payments into your portfolio is set up what's called a dividend reinvestment plan, or DRIP for short, which basically every time you receive a dividend payment, it's going to be reinvested right back into that asset by buying fractional shares of that stock, ETF, or REIT, for example, and therefore having those funds invested and out in the market making more money for you. Setting up DRIP is a really easy and straightforward way that you can take care of reinvesting all these dividend payments back into your portfolio with no hassle, and you never even have to think about it. And what's more is that most of all the ETFs and stocks that I've covered in all my previous videos are eligible for the DRIP program. So for example, if we look at the XUS ETF from BlackRock Management, when going down in the description of this fund, it's going to clearly indicate whether or not it is DRIP eligible. So just make sure you look at the different ETFs and stocks and see if they're DRIP eligible. Moving on now to the three next concepts in today's video. These are going to be less actual general concepts surrounding stock market investing, but they're rather technical analysis indicators that you can use in order to assess asset performance based on the financials of a company. So the first technical indicator that we're going to be covering is the earnings per share, or EPS for short, which we saw on the stock quote back on TMX Money earlier in the video. Quite simply here, the current EPS of a company is going to be the current company's net earnings divided by the current amount of outstanding common stock shares in the market. When used as a technical indicator to assess the investability of a company at the present time, the earnings per share can give a general snapshot of the profitability of a company at the current moment in time. For example, a negative EPS quite literally means that the company has negative earnings and is not profitable at the present moment in time. Generally speaking, the higher the EPS, the more profitable the company is. For example, if we look at the EPS of Tesla here, the EPS is negative, and thus the company is not even showing any net earnings on their bottom line at the end of the year. So although we can go much deeper into what an EPS is and how you can use it to your advantage to assess the investability of a company, for the sake of today's video, it's just a really basic stock market investing video. So we're not going to really unpack it and dive into it. So hopefully that gives you though a better understanding of what earnings per share even is when you're looking at a stock quote for a specific stock. Moving on now to the second technical indicator though in today's video, it is going to be the price to earnings ratio, or PE ratio for short, which once again we saw on the stock quote on TMX Money earlier in the video, and it builds off of the EPS that we just saw. Once again, quite simply here, the PE ratio is a current snapshot of the difference between the current market value of a specific stock or other asset divided by the EPS. The PE ratio is a technical indicator that allows investors to quickly evaluate and assess a company and compare its price to other companies typically in the same industry strictly on a quantitative basis. What's more here is that a company that does not have positive net earnings at the end of the year is not even going to have a PE ratio at all, because there's no earnings per share in the first place. Just quickly here so you can see a visual example of the formula to calculate the PE ratio, we have the current market price per share divided by the EPS. So this is the reason why the EPS as well as the PE ratio can fluctuate throughout the day, because market value per share also fluctuates. This is a kind of a concept that we covered in the dividend yield and why dividend yields fluctuate throughout the day. So if you want to learn more about that, actually make sure to check out the video I'm linking right up above here so that you can get a much better foundation and understanding of how dividend yields work in the first place. And finally, the last and third technical analysis indicator that we're going to be looking at today is one that you might not have heard of before. It is the price to book ratio, or PB ratio for short. The PB ratio is an indicator used to assess a company's current market value in relation to its book value, which is equivalent to the company's current assets minus its current liabilities. Once again here, we could honestly dive really deep into the concept of price to book ratio, but because this is just a basic investing terminology video, generally speaking, the lower the PB ratio, the better. And if you're able to purchase assets with a PB ratio below 1.5, this is going to be an indicator to you, the investor, that you're purchasing these shares where the assets are going to be really cheap compared to the actual market value of those shares. This is, for example, if the company theoretically were to go bankrupt tomorrow, then the current assets that the company holds are going to be one of the main sources of liquidation for the company. And therefore, if you had purchased shares of these companies where the assets were really cheaply valued based on that current market value when you purchased the shares, you're going to be in a winning position. All right, guys, I really hope today's video helped you better understand the concepts that we covered. And if you want to learn more about basic stock market and terminology, make sure to check out the first video that I covered this topic that I'm going to link right here as well as in the description. And if this video helped you out, make sure to give it a thumbs up. It really helps the channel grow and helps with the YouTube algorithm. So on that note, thanks again for watching, and I'll see you in the next video.